A year ago, your weekly shop might have cost you £50. Today, the same weekly shop with the same basket of goods costs you £55. You didn't change what you're buying, you didn't buy anything extra, yet it's more expensive. That's inflation. Let's talk about it. In the UK, the government uses the Consumer Price Index, or CPI for short, to measure inflation, and it includes hundreds of goods and services from food to fuel to a pint at the pub. Now that we know what they're actually measuring, we can look at what inflation actually is. Inflation is the persistent rise in price levels within an economy, meaning a decreased value of money in terms of goods and services it can buy over time. This means things like your weekly shop, Wi-Fi, rent, and other things will increase in price, cutting the amount your money is worth. So what could this actually look like for you? Well, let's say you shop at Tesco. You go around and you get all the items you need, like milk, bread, chicken, shampoo, toilet paper, and so on. In 2021, we use this here as a benchmark, and we'll say that the shop comes to 50 quid. Fast forward to 2026, and this exact same shop will cost you about £62.5 according to the Bank of England inflation calculator. It's a massive 25% jump in price in just 5 years. To put this into perspective, your income would need to have risen by 25% as well since 2021 just to keep the same standard of living. So why did this happen? Why do prices go up at all? Well, there's rarely just one reason for this. Inflation is complicated and often it comes from different places. So let's have a look at the main culprits. The first is demand pull inflation. This basically just means there is too much money and not enough goods in an economy. Now, this extra money could be coming from savings, loans, or even expansionary monetary policies from the Bank of England, such as printing more money. Because of this extra money that people have, they go and spend it on all sorts of things. This causes increased demand and leads to producers not being able to make enough of the products to keep up. Therefore, they increase the prices, and that's what demand pull inflation is. The second is cost push inflation. This type is about the cost of production increasing, which means everything becomes more expensive for the business to make. When something becomes more expensive to make, the business often passes this cost onto the consumer in the form of higher prices. These higher costs of production could be caused by higher energy bills, higher wages, or disruptions to the supply chain. A recent real-world example of this is in 2022 when Russia invaded Ukraine. This caused energy prices to explode in the UK, which led to electricity prices jumping over 75% in just a few years. Businesses couldn't just absorb these costs, obviously, so they put them on the price tag, which is a big reason your shop and bills have become so much more expensive. And this is when it can become dangerous. When prices rise like this, workers need pay rises to keep up with the cost of living, which is fair enough. But here's the problem. Those higher wages mean higher costs for the business. Now, how does the business deal with this? They increase their prices again, which means workers need higher wages again, leading to higher prices and so on and so forth, in a self-fulfilling cycle that is really hard to break. This is sometimes called built-in inflation, or more commonly, the wage price spiral, and it's just one of the reasons why inflation can be so stubborn and difficult to control. So who actually tries to control inflation in the UK, and how? Well, that's the job of the Bank of England. Their main weapon against inflation is interest rates, which you've probably heard of. But what does this actually mean? To start with, the Bank of England's job is to keep inflation at about 2% per year, not zero, because a small amount of inflation is actually healthy for an economy. Now, the Bank of England sets what's called the base rate, also known as the bank rate, which is essentially the rate at which it lends money to other banks. Those banks then add on to the bank rate and pass it on to you in the form of mortgages, loans, and savings accounts. If inflation gets too high, the Bank of England will increase interest rates to incentivise savings, since higher rates equals higher returns, and also make borrowing more expensive. For you, this means higher mortgage payments and credit card payments will become more expensive. Therefore, it lowers disposable income, in turn lowering spending and demand in the economy. It also works the other way too. When spending is too low, they cut interest rates to encourage borrowing and increase demand in an economy. A prime example of this is after the 2008 global financial crisis, where interest rates were slashed almost to zero to stimulate the economy. Now, this all sounds straightforward, but it's a balancing act, and getting it wrong can have serious consequences for everyone, including you and me. Overall, Inflation erodes the value of your money over time, which means if inflation is rising faster than your income, you'll be worse off in the future than you are now. That's why understanding inflation matters. Thanks for watching. Hopefully this helped you understand inflation a little better. If it did, subscribe would mean a lot.